the bank stocks have turned around. JPM and Goldman on the back of their earnings are not quite positive, but they're well off of what their lows were, and that's helped the market too. The market just needed a little time to wake up to what was pretty good earnings.
Yeah, I think the challenge is, Scott, is the financials have been performing so well over the past couple of months, particularly the banks, and anticipation of yet another strong earnings season. If you look at JP Morgan, for instance, in terms of their guide, typically conservative, and so maybe there were some questions coming into the earnings report. Would this be as good as perhaps people were anticipating? However, what's most important is that we're starting earnings season. That's a huge catalyst for this market. We've been listing a bit over the last couple of days, particularly as China concerns have amplified once again. And so we're at the precipice. You spoke to it, a couple of early industrials, financials, where even before tech comes to the fore, we're likely to see companies besting those expectations because we've come in with very low consensus expectations for this earnings season. And so wouldn't be surprised to necessarily see these beats and see these turnarounds kind of post-earnings calls for many of these companies.
Yeah, Joe, if you look at we can show you again, the intraday moves of the S&P and even the Dow for that matter pretty much track the comeback that we've seen in some of these financials. You own JPM and Goldman, and as I said, though still down, not nearly as bad as they looked early on.
And obviously, Scott, the events of the last several days raise that you need to focus on what's your leverage. What positions do you hold that could be a source of liquidity? So coming into financial earnings, I was very concerned with the significant overweight exposure for Joe T. We heard from Goldman Sachs. We heard from JP Morgan. We're talking about historic trading revenue numbers, fantastic quarters, everything looked great. But as Shannon mentioned, very high expectations. You did hear some commentary from David Solomon and Jamie Dimon that could be interpreted as being somewhat troubling. But I think overall, you look at the financial sector itself, you look at our overweight exposure, and maybe today it's not about JP Morgan and Goldman Sachs. Maybe today it's about others like Fifth Third, like Capital One, like Synchrony, like American Express. It's one of the reasons why I am not troubled or taking action in any of the financial positions we have, because I still think the momentum is there and the fundamentals support it as well.
Stephanie Link today is like, that's why Wells is my largest position in the market, because I know that she was expecting good things, and she certainly got it. That stock's up almost 7%, is Wells. So it's worth noting. Josh, you obviously are in JP Morgan. What do you think about what you heard? As again, that stock looks different now than it did just a couple hours ago.
Yeah, the business is absolutely rock solid. And I think the guidance for next year, net interest income, the consensus was at $100 billion. And they sort of said, we would tell you that $100 billion might be a little bit low. That's music to my ears as a long-term shareholder. I thought the other interesting thing that came up on the call, there were a couple of different analysts who asked questions in different ways about NBFIs or non-bank financial institutions. And maybe that's very relevant to the room that you're sitting in, Judge. But there is increasing concern from the sell side about whether or not there will be an impact at the banks for this boom that we've seen in private credit, direct lending, et cetera, et cetera. This was the first time on the conference call that Jamie barged in and wanted to say something, which I thought was interesting. And what he said was, I probably shouldn't be saying this, but there's never just one cockroach, end quote. So that is an interesting thing. As a JP Morgan shareholder, I don't worry as much about that as I might if I were directly invested into one of the private credit companies, for example, that's public on the market. But I do think that'll be like the big risk in the fourth quarter is if people get nervous about the First Brand situation, or there are others, or the bank's adequately reserved, et cetera, et cetera. That's pretty much the only risk I can really come up with at this point. So outside of that, if capital markets hold up, I think this sector remains bid. Companies like JP Morgan that are considered to be the safest houses, I think will hold up the best. And I want you guys to put up a quick chart of BlackRock, because this is a name that we talked about. It's on the best stocks in the market list. It's on the verge of a big breakout. Not intraday, guys. Give me like a year, please. All right. Take a look at this stock. It's about to take out the historic highs from a few weeks ago. When I listened to that call this morning, there was nothing that told me that this is a business that is seeing deceleration anywhere. They're doing revenue in crypto, in cash management, in fixed income, in obviously equities globally. It's $13.5 trillion in AUM around the world. And I feel like if the markets stay as healthy as they have been, this is a very obvious way to capitalize on it.